All right, I'm going to take a look at gold in the stock market. Post-employment report. My last video I said the employment report was a potential trigger event to put a bottom in the intermediate decline in stocks and also in gold. I may be keying off of gold here because I think when gold bottoms, probably everything else will bottom as well. So when we got this breakdown below this support zone here at 1750 on this day, I did a video. I said that this looked like more like the beginning of a bloodbath phase than what I was anticipating before was just a lot more of this grinding move down that would take several more months. We'd get lots of counter trend rallies as people keep trying to pick a bottom, and then it keeps fading away. But then that kind of changed when we get this breakdown here. We didn't get the immediate bounce back that I was expecting if we were going to continue that grinding phase. So you can kind of see here, you get a breakdown below this low and you get a quick bounce. You get a breakdown below this pivot here, you get another quick bounce. You get a breakdown below this pivot, you don't get a bounce. You just keep getting more and more selling. So that's more indicative of a bloodbath phase, which is the ending panic exhaustive selling phase of an intermediate decline, than it is something that occurs in the middle of an intermediate decline. So this is more indicative of the end of an intermediate decline here. So first thing, these bloodbath phases, that not all of them, but the vast majority, they run 5 to 7 days. I have seen a few that run longer than that, but most of them 5 to 7 days. So I count the breakdown below the support. That's what I count as day one. So this would be one. And so today we're on day 6, 5 to 7 days. It's possible that we are getting our bottom today. We're going to at least need to see a swing, and obviously that can't happen today because we made a lower low. But on Monday, if assuming this is the top here at 1705, on Monday, if gold goes back above 1705, then we would get a swing, and at that point, I would be inclined to think that the bloodbath phase may be over, and the intermediate decline here might be done. Another hint is that the mining stocks haven't really followed gold down as it continues its bloodbath phase. So here was the bloodbath phase day right here. Gold has just continued down, but miners have started to chop sideways, which seems would be an indication to me that we may be putting in a more lasting bottom here as the miners start to diverge from the price of gold. All right, so moving on to stocks. If I just look at this in the perspective of the S&P, I would say we just got a lot further to go. As I've noted before, my minimum target most of the time for an ICL is at least back to the 38% Fibonacci retracement, which in this case comes right around in here at 3660-ish, and we aren't there yet. And we also haven't moved back below this daily cycle low yet. So, if I'm just looking at the S&P, I would say we got more to go. However, this ICL hasn't been so much about correcting the S&P. It's been about correcting the leading tech sector. So let me move over to the Nasdaq Composite. And so looking at the Nasdaq Composite, we have definitely done enough to call this a full intermediate cycle low. This can bottom anywhere in here, and I would look at this and say, yes, we've done enough damage for this to be a completed intermediate cycle low in the Nasdaq. We've got our ABC pattern. Here was our first leg down, then the bounce and the turn sideways and the C wave down. I guess you could vaguely call this a daily cycle low, so we've broken below that. The bullish percent index is down to 20%. The McClellan oscillator on the Nasdaq is, I believe it was about down to minus 90. So we've got all the parameters we need to see. And I also showed the weekly chart yesterday. The prices dropped below the 10-week moving average, and the 10-week moving average is turning down. So basically, we've done all we need to do for me to say, all of the parameters have been met for an ICL. Now we just need a turn. We don't have to go lower to complete, some other parameter that hasn't been met yet. We've done everything we need to do and I believe this is a 38% retracement here. Let me check that. All right, so here I put the Fibonacci retracements. You can see we've actually gone below the 38%, so we've covered that requirement as well. We're 23 weeks into this intermediate cycle. The average duration of most intermediate cycles from trough to trough is between 22 and 25 weeks. So we're right in the middle of the normal timing band. So based on where most of the correction is occurring in the tech sector, we've met every requirement we need to meet. Now we just need a turn. And I tend to think that once gold completes that bloodbath phase and turns back up, that will be the signal. And once that happens, then everything else is going to turn back up too. So basically, I don't think gold is going to complete its bloodbath phase, turn and start an intermediate decline, and in the meantime, the stock market's just going to keep dropping. I don't think that's going to happen. I think when the sentiment and the fundamentals, which in this case I think the bond rates are going to turn and go back down, and probably the dollar's going to top. When that happens and gold turns back up, I think that those same fundamental drivers are going to turn the stock market back up. So, as I mentioned before, I'll go back to the S&P here. I'm expecting a short daily cycle. This daily cycle was really long, so I'm kind of expecting this one to be a little short. So I don't necessarily think we're going to have to run 35 to 40 days before this daily cycle bottoms and we get our final intermediate cycle low. We're on day 25 now. I'm looking for a final bottom here somewhere between 25 and probably 30. So it's possible that it bottomed yesterday on Thursday. We'll just have to see. I suspect more likely we're going to get a bottom either Monday or Tuesday. And then once that's done, then we'll start back up and we'll get the next leg up in the bull market.